Hi and welcome back to Mr. Allred's 5 Minutes On. Today I'm going to be talking about the concepts of sole traders and partnerships. Now this is going to be geared really towards an A-level understanding, especially when I start talking about the advantages and disadvantages. If you're a GCSE student though, it's still beneficial for you because it will definitely be in your specification. Forms of business ownership are one of those topics that get tested a lot. It's like the basic fundamentals of business. So in any course line, I'd be surprised if a year goes by that you don't have a question at least on one of these, because it's such a wide topic and a big topic, and also there's lots of detail to it. So often you get a lot of questions on this, and they can test from a very small question up to a very long essay based answer. So let's get going then with sole traders and partnerships. So these, like I say, are forms of business. They're legal structures of how a business can set up and operate. So let's start with a sole trader. Sole trader is one person who creates a business and has sole responsibility for the decisions made within that organization. And that's key, really. It's about the decision making. It's not necessarily about that person being on their own, because often they will have employees, often they will employ people, but it's really about who makes the decisions. And in a sole trader or a sole proprietor, it's that one person, that owner. It's really easy to set up as a sole trader, really quick and easy. There's a few loopholes you have to jump through, but realistically that's really quick and easy. You phone the tax man, tell them that you're now a sole trader, and they change your tax code for that. You will still have to pay national insurance, you will still have to pay income tax depending on your revenue levels. You have to register for VAT potentially, especially if you want to claim that back, if you're paying a lot of VAT and you want to claim that back. And you may need a license to trade if you're a taxi driver. If you want to set up as a selling alcohol or anything like that, you might need another license to be able to trade, to say that you're okay to trade in that field. And there's some key advantages of being a sole trader, not just that it's really quick and easy to set up, but you get to keep all the profits. Any profits made are yours. You don't need to split them. There's no shareholders, there's no partners, they're all yours. You have complete control. Your decisions are final. You're the person who makes those decisions, and those are the ones that go in place, and really taps into Maslow's sort of hierarchy of self-actualization there. You're making the decisions and seeing those through. It's a flexible organization in a sense, because it's quite small and it's not got a great deal of output, and it probably doesn't hold a lot of stock and those sort of things. It's really quick for them to change based on consumer demands and give consumers what they want quite quickly. It's a real flexible organizational structure at that point. Because they're smaller and because they tend to have a smaller sort of customer base, they can tend to offer a more personalized service. They tend to be able to get to know customers. They rely a lot on repeat business, and as a result, it tends to be that sort of localized service that they're offering. There's some key disadvantages, and the biggest disadvantage is the concept of unlimited liability. Now, this is one concept that lots of people get wrong, and it's a concept that often I see when I'm marking exams for the exam board that people make mistakes on. Unlimited liability. In law, if I set up as a sole trader, me, Mr. Allred, the person, is seen as the same legal identity as that business. So if that business gets into debt, Mr. Allred, the person, is in debt. Those two things aren't separate, they're incorporated, they're the same thing. And as a result, if that business gets sued, it's me being sued, and I'm liable for all that money. I have an unlimited amount that I am liable for. So if that business fails, often I might have to forego and pay off that debt by selling my house. That might be repossessed. I might lose my personal assets, and that can be a real disadvantage for me, and a real sort of negative consequence of me joining and trying to start this business. It's hard to raise finance as a sole trader. It's really hard to get banks to buy into you. Independence can be a burden. Often you're pulled from pillar and post. You're making decisions on every facet of your organization, and that can lead to a lot of stress. You also don't benefit from economies of scale, those cost benefits as you get bigger. Because you're small, you just can't tap into that. You don't have any power over your suppliers. So let's look at a partnership now. So the partnership can be defined in the Partnership Act of 1890 as the relation which subsists between persons carrying a business with common views on profit. Well, what does that mean? Essentially, multiple people starting a business for profit. That's really what it means. Decision making here then is shared. Often These types of businesses will be classed as what we call professionals, like accountants, veterinary services, solicitors. These are often what we see as partnerships. And the clue's often there because lots and lots of different businesses who are partnerships tend to use their last names as the name of the business. And that's how you can kind of spot those there. To set this up, you need a deed of partnership. This is a legal document that basically sets out the rules of engagement for the partnership. It sets out the capital contribution, so how much each person's putting in, and how control, therefore, of this organisation is split. It talks about how much profit and loss and how that is going to be shared. It looks at the procedure for ending the partnership. It looks at the rules on new partners joining. Now, there's some key advantages for this. It's easy to set up. We can have specialisation. Because there's multiple people have different sets of skills. I might be great at marketing, my partner might be great at finance, somebody else might be great at sales, and we specialise in the area that we're great. So specialisation can occur, and it makes that business run more efficiently and can be better and sort of add to the overall benefit of the business. We have a shared burden. We share that burden of stress, and that can really start to limit the impact on me personally. And more owners equals more capital, and more capital can help the business grow better. The business can get bigger, it can sort of get better technologies and those sort of things, and eventually lead to a greater organisation. Disadvantages still exist though. Unlimited liability, that concept I talked about earlier, is still in place with partners. These partners are seen as the same legal identity as the business. The debts are shared, however, based on what it says in the deed of partnership. Those losses are shared based on the proportion that it says in the deed of partnership, but still can be liable for that debt. I have to share profit. I might be working a lot harder than those partners, but I still have to share the profit with them as it lays out in the deed of partnership. Often partnerships lead to disagreements. People might disagree with each other over how the business should be run and how the business should work. As a result, the decision made by one partner legally binds the other partners into that decision. So if the partner makes a decision that's bad and doesn't necessarily work or causes harm to a consumer, well, the other partners are therefore liable for that as well. So it can be really difficult to run a partnership because you've not got one vision, you could have several visions. And then as a result, arguments occur. So this is Mr. Allred's 5 minutes on. I hope you've learned something today. Please like the video and please subscribe to the channel.